Well, hello everyone and welcome. So before we start, we do have a call for papers. It's on our website, and I should have probably checked it to tell you what the deadline is,
It's
but I
June
didn't.
26th, Katja.
It's June 26th, so you still have a month and a half. Please submit the paper via the website. Oh, now I see it's June 26th and it's 11:59 p.m. Pacific time. Um, Now we're going to move to today's talk. We're very pleased to have Win Monroe from Copenhagen Business School, who's going to talk to us about dealers, information, and liquidity crisis and safe assets. Win is welcome you're welcome to send in your questions to raise your hand at any time, except maybe for the first few minutes. When we want to get through the introduction without being particularly disruptive. But if you have any clarifying questions, still again, please feel free to ask. And on that note, Win, the floor is all yours. Thank you.
Perfect. Thank you so much for including our paper. I've enjoyed the microstructure exchange and being able to come and join for a lot of seminars. So it's really nice to be here, myself presenting. So this project is joint work with Robert Czech of the Bank of England, which means all the kind of standard disclaimers apply. And the project is on dealers, information, and liquidity crises and safe assets. So a little bit of motivation here. We've seen that liquidity crises are increasingly common in safe asset markets such as treasuries, gilts, bonds, these kind of markets. And two, really big episodes that come to mind are the Dash for Cash in 2020 and the UK's LDI crisis in 2022. And these were, really important crises. They're crises that resulted in large central bank interventions, some of the largest in history. And so really understanding their causes and mechanisms, we think are an important kind of first order financial stability question. Now, for people joining the microstructure exchange, none of this is going to be new, but just to make sure we're all on the same page, government bond markets are generally traded over the counter, where investors trade through dealers who offer to buy and sell on demand. Now, most of the prior research on liquidity crises and stress episodes in these markets have either focused on the one hand on investor fire sales, which drain liquidity from the market, or on constraints on dealers, like regulatory constraints, for example, who are supplying liquidity to the market. And so what we're going to do that's very different than this literature is take an informational view at these questions in these episodes. So at a high level, our question is going to be, can information play a role in safe asset liquidity crises? And if so, how and why? And I think the way that we normally think about the relationship between liquidity and information are through adverse selection models, most prominently Kyle 1985. And in these models, essentially, a dealer doesn't really know if they're trading against an informed or uninformed dealer or investor. And so, in some sense, they're kind of implicitly assuming this market is like an anonymous market. And the result is that when dealers are concerned about, the potential risk of trading against an informed investor, they raise trade costs on everyone in order to compensate for that risk. In contrast, more recent models that maybe have a bit more institutional realism to them, where dealers can distinguish to some degree amongst different investors, show that dealers, if they can conjecture which investors might have some informational advantage, may actually end up reducing trade cost for the most sophisticated, high-performing investors in order to learn from them and better position themselves in future trades. So, the way that you might think about this happening is that a large sophisticated investor like, Brevin Howard or Rokos or, a big macro hedge fund will go to a dealer like Goldman Sachs. And if they have a large trade that they don't want to reveal the direction of, they can request a two-sided quote. And if the dealer wants to really learn their position, then they can offer particularly attractive quotes. And then if the trade is agreed to, now the investor has gotten discounted liquidity and the dealer has learned something about the investor's view on a bond, for example. So what we're going to do in this paper is we're going to study this empirically. We're going to be able to make some progress on this because we have a really nice administrative trade data set from the UK. And the main feature of this that's really going to help is that, unlike other commonly used data sets like Trace in the United States, we can track both sides of the transaction, both the investor and dealer over time. And so this is going to allow us to control and purge out a lot of potentially confounding variation, security time variation, dealer time variation, which means we're going to be able to exclude things like dealer level factors such as regulatory constraints, risk appetite, so on and so forth. We're going to be able to control for investor dealer relationships. And in some of our aggressions, we're also going to be able to control for liquidity demand a la Kwajalein type estimator. We're going to do this primarily by looking at the UK's 2022 government bond market crisis as an empirical laboratory. And we think that this is a nice setting because it's a sharp shock to the financial system. It's in a bond market that has a similar market structure to other large bond markets that we care about, such as the US, Euro area, and Japan. And we think that this informational view is important, even if it's not necessarily mutually exclusive to some of the other views, such as a more kind of fire sales view or a more regulatory view, because it's going to have different predictions and policy implications. So, for example, a regulatory view of liquidity crises in safe assets is really going to suggest that that the variation in trade costs and illiquidity in general should be driven at the kind of dealer level and by dealer level factors, such as a dealer that's kind of closer to their regulatory constraint. And it might suggest interventions like temporary regulatory forbearance. And if we think that that's kind of the whole world, then, fine. But if we think that, there's also potentially an informational view of the type that we're suggesting, this can suggest, different predictions for what we might expect to see in the variation in trade costs. So we, would expect to see variation really driven at the investor level within given dealers and could have different policy implications, such as interventions that shift investors' beliefs or even ex ante market structure design that affects how information flows through the market. Um, just real quick, I'll summarize at a high level the main results. First, we provide several stylized facts. We show that dealers sharply increased their trade costs and net sell bonds at the beginning of the crisis. And we decompose the price dispersion into this across and within dealer portion. And we find that the within dealer portion increases from about 30% of the total variation in trade costs to 70% at the peak of the crisis. And so we really think that this suggests that dealers' allocation of liquidity costs is really an important part of driving overall the liquidity in the market, at least in the initial phases. Next, we show that dealers actually reduce trade costs for high-performing, sophisticated investors on the order of 20 basis points in our baseline measure. And this is a really nice result because we can see it both in the raw data and also in a much more demanding two-way fixed effects model with all the controls that you would expect. And we'll do a bunch of work to try to show you that this result is really not driven by other common explanations like dealer constraints, competition for relationships, or compensation for client supplied liquidity. Next, we study dealers' behavior after gathering information, and we find that essentially what we want to do is we want to compare two dealers, one with more informed order flow versus a dealer with less informed order flow. And of course, dealers' information gathering is going to be endogenous, and so we're going to approach this using a shift share instrument to try to address some of these concerns. And what we're going to find is that dealers with more informed order flow raise trade costs on uninformed investors. They reduce their net bond holdings, so they're in a sense kind of absorbing less fire sales pressure, and they reduce their total intermediation, especially in bonds that are under fire sales pressure. We also find that these dealers increase their trading profitability, and primarily in the anonymous inter-dealer market. And so we think that this provides, a financial and kind of economic incentive for them to gather this information. Next, we show that informed investors and dealers' order flow predict fire sales. And finally, we do some work to reproduce some of our main results in the COVID Dash for Cash, which we think supports the external validity and kind of general nature of the mechanism that we're identifying here. So that's already kind of a long introduction, but I think, we've really gotten through the kind of high level overview of it. So it's probably a good time to stop and see if anyone has any questions.
A quick clarifying question.
Sure, please.
Is the data on the spot market for these bonds or some kind of derivatives?
So we're going to be looking at just the cash market. Of course, there could be other behavior going on in related markets. We know there's lots of trading in futures and exchange rates during this time. But in general, we think that, that should mostly work kind of against our results. And, to the extent that we find a lot of this behavior just in the cash bond market alone, we think is pretty striking.
And when you say informed investors or sophisticated clients, like who do you have in mind?
So I'll go into that in more detail in just kind of a slide or two, but essentially we're going to look at our baseline measure is going to be looking at which investors their trading best predicts the future movement of bond prices over the next few days. And of course, in the paper we have 1,000 robust. I mean, a lot of alternative definitions to this as well. Any other questions before I kind of hop into the next section? No? Okay. Well, from here out, really feel free to stop me at any time for questions, both small and large. Standard outline here, I'm going to talk a little bit about the background and data. Then we'll start jumping into some of the more serious results. First on information chasing, next on dealers' behavior after kind of gathering information, and then on some of the kind of interesting bits and pieces on, what are the potential sources of this information ledge and external validity. So background. This is not really a paper about the mini budget crisis. There are some papers that really go through and do a very nice kind of, case study on what was driving what at the time. But just so that we're all kind of have a sense of the setting for the kind of primary test that we're going to be doing. Essentially, what happened was central banks around the world were raising interest rates because of inflation, and in this already kind of fragile bond market, the UK's essentially chancellor, their kind of Treasury Department, announced a mini budget that provided for a lot of unfunded tax cuts. This really spooked markets, and interest rates began to spike rapidly. For example, the 30-year gilt jumped about 140 basis points in 3 days. Once the mini budget was announced and interest rates really started spiking up, large pension funds and liability-driven investment vehicles suddenly had margin calls on a lot of their derivative positions and had difficulty rolling over leverage positions in the repo market and were forced to fire sale bonds, government bonds. And so essentially you have this kind of mini budget and then fire sale that left the market really cratering. And so about a week later, exactly a week later, the Bank of England intervened with financial stability asset purchases at the long end of the curve. These ran until October 14th. And a little bit before the end, they also expanded the asset purchases to include inflation-linked bonds as well. After the interventions, yields retraced to roughly where they were before the mini budget. So that's kind of the setting that we're looking at. That's this kind of sharp shock in yields. The first stylized fact that we're going to look at here is price dispersion. And one of the reasons that price dispersion is nice for our purposes is going to allow us to decompose the sources of price dispersion into this within and across dealer portions. So price dispersion is just when the same bond is trading at different prices at the same time. Our kind of baseline window throughout this is going to be a 30-minute window. And, it reflects this kind of limits to arbitrage. So, there's lots and lots of bonds that are being traded, essentially at very different prices in a short window, and they're not being arbitraged because it's, a stress environment and the limits to arbitrage have gotten, much tighter. And here you can essentially decompose the within and across dealer portions of this by adding and subtracting the dealer's average price for the same bond in the same window. And again, we expect that this across dealer price dispersion should really reflect dealer level factors such as regulatory capacity, while the within dealer portion should primarily reflect dealers' allocation or distribution of liquidity amongst the different clients. So we calculate this price dispersion and kind of sum it up for all the different bonds and have the splits into the cross and within dealer portions. We can see that this within dealer portion grows from about 35% at the beginning or before the crisis and peaks at just about 70% at the beginning of the crisis. So we think this really suggests that dealers' allocation of liquidity is an important driver of overall liquidity in the market, and that it's not just about dealer level factors like regulatory constraints or risk appetite. So a little bit more on how we're going to measure informed investors.
Sorry, can I ask?
Yeah,
You
please.
said even before the crisis, the within dealer is like a 30% price dispersion.
Sure,
That
yeah.
seems quite high, no? Is it like what is it normally driven to outside of prices? Just so that I have the baseline.
Sure. So, I mean, maybe we should have also calculated this for some period kind of way before the crisis to have a better benchmark. But, dealers are always going to be allocating liquidity, amongst the different clients for kind of a variety of potential reasons. Some of it might be to kind of learn about order flow. Some of it might be, because of relationships or because certain transactions seem valuable. So, kind of any potential reason that they might, prioritize one client over another.
But the 30% is like a regular baseline, or was it already after the mini budget was announced?
So this is before the mini budget. The mini budget
Oh,
is
okay.
announced on the 23rd. We
Oh,
should
okay,
probably
okay,
just put
okay.
like a red line in there on the like
Okay.
fifth bar or
Sorry, I
whatever.
forgot the
The
exact
fourth
date. I
bar.
remember
Yeah.
it's
No,
yeah.
no, no.
Thank you.
Yeah, exactly. So, it's really kind of steeply increasing here once the mini budget is announced.
So wait,
So,
can I ask?
sure,
This is
please.
Robert Minkveld. Why did you choose to look at shares? I mean, there is information in the levels and how they change. That's where I would look.
Yes, that's
Why
true.
is
So
shares so important?
Yeah, so price dispersion is kind of going up overall. Let me see. I have the time series here. I can't remember if this one is in levels or in. Yeah, so here we have. Oh no, but this is just the inner dealer market and the dealer to client market, but it still gives you a sense. So this is here we can see the kind of level of price dispersion in basis points. And really, in the chart that I showed, we're just focused on the dealer to client market. But you can see in the dealer to client market in levels, it's quite low, and then after the mini budget, it starts increasing really rapidly.
Yeah.
Yeah.
Yeah, I find this more interesting, but okay.
Yeah, no, I mean, some of the origins of this, project come from me seeing something, somewhat related about this in a paper on the LDI crisis and really thinking about like what could be driving the within and what could be and how might we, what might that be speaking to? We could in some sense write, a whole microstructure paper just thinking about some of this stuff.
Yeah, the levels I actually seems more more intuitive to me too. I think that's where my confusion stemmed from.
Yeah,
too.
yeah. I mean, this felt like a nice way of kind of summarizing it, but maybe we could include the levels across these as well. Thank you. Okay, so information. This is something that people typically do not think or talk too much about in government bond markets. I mean, we normally think government bond markets are trading on kind of publicly available information, data releases, macroeconomic policy announcements, this kind of thing. And, that's true. They're highly liquid markets and they are primarily driven by this publicly available information. Nonetheless, there is research that suggests some sophisticated investors really can outperform in government bond markets. And that research is has primarily focused on two potential sources of informational advantage. One is a superior ability to predict macroeconomic events. And so, there's some evidence that they seem to, predict the right way before data releases. And so you can think about During COVID, some hedge funds were hiring lots and lots of economists to pick through inflation data and this kind of thing just to have some small edge. And the other source, potential source of informational advantage is predicting other investors' order flow, or in some sense, kind of trading ahead of them or processing information more quickly. So in this sense, it's kind of like if there's some, information and you process it much more quickly than, say, a pension fund. Or you have some information about a pension fund rebalancing the future and you're trading ahead of it. These kind of things give a high performing, sophisticated, fast moving investor an informational advantage temporarily. So we think of these as kind of the broad theoretical and kind of previous research that suggests that this is not an unreasonable place to look. And we're going to, in at least our baseline measure, follow the literature and essentially rank investors based on how well they predict the future movement in bond prices. We're going to adjust for execution costs because, of course, execution costs is part of what we want to study here. And so what we're going to do in our baseline measure is look at a bond's future price, T period, capital T periods ahead. And so that'll be P capital T. And we'll compare it with the transaction. Well, you would normally compare it with their transaction price at that time. And instead, we're just going to take the average market price at that time. So that's going to be P bar T. And so this kind of strips out any favorable or unfavorable transaction costs that they might have, and essentially says, if you buy or sell at the same time as this investor, how well is that going to predict the bond movement prices several periods ahead? In our baseline measure, we use 3 periods, but in the paper we use 3 days but in the paper we're going to use 1 day, 5 days. We're going to measure this in risk adjusted terms and a lot of different other ways. But this is basically the main way that we're going to classify them. We're going to take every trade. How well does it predict the future movement in bond prices? We'll take a volume weighted average, accumulate over the sample, and categorize the top tercile of asset managers and hedge funds as informed investors. So the other kind of main measure that we're going to use throughout this is going to be our baseline trade cost measure. Here, we're going to look for some transaction in what is the realized price P star, and we're going to compare it with the most recent price for that same bond in the interdealer market. Now, this is a pretty kind of intuitive transaction cost measure. Essentially, it takes like the dealer's perspective, where a client comes to a dealer and says, we want to buy or sell a bond, and a dealer looks into the interdealer market real quick to see, what they can potentially lay off the bond at or acquire it at, and have some sense of, what their costs and risks might be. It's a nice measure also for our purposes because it's going to difference out security time variation. And so changes in kind of fundamentals or demand for particular securities is going to be absorbed in this measure. And, we can kind of already see the first main result, like I said, just in the summary statistics here. If we look at the kind of average trade costs for uninformed investors, it does exactly what you'd think from the pre-crisis to the crisis period. It moves from about 3 basis points to 22 basis points at the crisis. So it goes up significantly. And what we find for the informed investors is that their trade costs go down during the crisis. And this is not only in terms relative to the uninformed, but in absolute terms. So they're really receiving like very significant trade costs at a time when everyone else trade discounts in a time when everyone else is getting charged a very significant premium. Yes,
can
we
I
have a
interrupt with a
question?
question?
Yes, please.
The informed trader, is that identified at the financial institution level, or or is it finer, more granular than that?
No, yeah, we're going to do it at the institution level. Exactly. I mean, there's a little bit of data potentially to disentangle at the trade level, but we haven't done that. It's a bit messy. So, yes, we have another question here from Jane, I believe. Sorry, go on.
One more. So, do you do that classification then pre-crisis, and then assume that institution is then informed throughout the crisis?
What a wonderful question. So you could really justify it either way, right? Like on the one hand, you really want to know who has some informational edge, and so you might think about which investors, really outperformed during the crisis. On the other hand, there's some kind of maybe uncomfortable timing of that. Maybe some people just get lucky, and so that's a little tough. And so in our baseline measure, we're going to use their trading performance in the month leading up to the crisis and cut it off right at the mini budget announcement. However, we're going to find that these investors are generally the same investors that kind of outperformed then.
Okay.
And we do a little bit of work on this as well. And so, here, for example, we have informed ex post. And so these are the people that really outperformed during over the actual course of the crisis. And then we have our baseline informed measure, which is kind of ex ante. And we can see that, they really are kind of highly correlated. And interestingly, because we also studied this other episode, that these are also, many of the same investors that outperformed in the COVID crisis. So it really suggests that like there are some very, high performing sophisticated investors that are working to be at the frontier of the kind of informational advantage, regardless. So another
Great.
question here.
Thank you.
Yes, please.
Yeah, so thank you. I mean, I think that's very intriguing. So my question is this really a cost and or is it just alignment with their inventory positions? Because the trades of these top hedge funds, right? They may be more endogenous compared to somebody who's panicking and coming from the retail side, or they just want to sell the bond at fire sale, right? But these guys may be more cautious that these are ultimately risk-free assets, so they have more
So
willingness to trade. Yeah.
uh, just to see if I kind of understand the question correctly, is the question, is this driven by informed investors getting discounts, or is it really being driven by, panicked investors getting charged premia? Is that the question?
Right.
Yeah.
Yeah.
So I think there's kind of two things that speak to this. The first is actually this table where the informed investors are actually getting kind of almost like a negative bid-ask spread during the crisis in kind of absolute terms. And so this suggests that, a lot of their benefit is not just kind of relative to the uninformed, that they kind of on their own are receiving, a discount in absolute terms. And so I think that's suggestive that
So
it's not.
that's the one I'm also questioning, that is that
Okay.
they may be just sitting there and they have the positions or inventory. So people are coming to them to demand liquidity. They're not seeking liquidity. They may be providing
Right.
liquidity.
So, okay. So, sorry. Now, I'll have something on this in a moment, but okay, just to make sure again that I've got this correctly, essentially the question is, are the quote unquote informed investors really just being compensated for supplying liquidity to the market?
Right.
Yes, exactly. So that's a good question. We do a bunch of tests on this later that I'll show. And essentially the answer is that is also going on, but it does not seem to be driving our results. That there seems to be kind of, two levels of compensation there. Great. Albert.
Uh, yeah, I'm a little bit triggered by the way you set this up and the way you framed it, because
Sure.
you're saying the sophisticated investors, they either predict macro events or they simply predict other investors' flow. And it's really important to distinguish these two channels, because if you're able to predict macro events, you're actually being good to a market in an informational sense. You're adding information about stuff that's about to happen. If what you do is just you get a peek at your client's flow and then you basically back run on it, or then you're not really producing a lot of economic value, informational value in a way, because that information would have arrived at the market anyways. A little bit of the latency arbitrage in the Buddhist papers. And what you're saying is like it seems to be more the second, because if it's happening before the event, if the people that are informed are in the same people before the event as they are after, then before the event, like really before the event, they don't have. That's not about predicting events. That's about, they must be cleaning the same customer flow and running on it. But I would encourage you to go more explore what these, or maybe you have to, if some results there
No, yeah.
forward to learn.
You are absolutely right. And I think this question also comes in I think your version of this question is a much more precise and nice way of putting it. But I think the more general form of this question we often get is you know is this good, bad? What are the welfare implications? This kind of thing.
Yeah.
And the honest truth is we basically have not really done that here. I think what we have done is we've kind of shown, I think we will show that, there is some element of it that seems driven by this kind of front-running effect. But we can't exclude and we don't try to measure or decompose it into these two different factors. It would be really nice if we could. I mean, in other papers where they have kind of done this, they will do things like they'll look at, the release of, data releases over time as kind of a measure of macro prediction, for example. But because we're looking at this one episode, we don't have like a lot of macro events in order to kind of try to easily statistically quantify it. We could imagine trying to do, some kind of model that would then, tell us a little bit of like what is the value of the information if it comes from one source versus another. And we know that in some papers they show that, there looks like there's also some effort to kind of whether you call this predicting or front running, get ahead of like the Bank of England interventions and this kind of thing. And so, whether that's useful or not useful, maybe they're helping the central bank get away, or maybe they're making a quick buck on, so like you could kind of interpret that in different ways. We don't decompose it, and you're right, we would need to in order to kind of weigh the informational advantage versus maybe the illiquidity costs is how I think about it at a high level. And we don't do that here. I think we just kind of show that this latter effect is there in some degree.
All right.
Yeah, but you're totally right. I think in a perfect world we would find a way to do that. If you have suggestions, it would be great. Yeah. So just to kind of bring us back here, and I'm going to go through this next part a little bit more quickly, but just to bring us back here, essentially we saw that informed investors are getting very low trade costs once the crisis begins, and uninformed investors are getting very high trade costs. Of course, this is just kind of summary statistics, so it's subject to all the kind of standard concerns about endogeneity and measurement and so on and so forth. So here, I'm just going to kind of quickly walk you through the kind of more sophisticated two-way fixed effects model to study this. We're going to have our same trade cost measure on the left-hand side. This is between, for some transaction in between an investor I, a dealer D, and bond B. And throughout when we use time periods, it'll be a 30-minute window. On the right-hand side, our main coefficient of interest is going to be just the interaction between a crisis dummy and a dummy for whether that investor is informed. And then we're going to have a bunch of fixed effects and controls. So we'll have dealer time fixed effects, which means that we're really looking at one dealer trading with two different investors, one who is informed and one who is uninformed. We're going to control for whether the investor breaks up their trades amongst different clients or different dealers. We're going to have investor dealer fixed effects, which will at least control for the time invariant value of trading relationships. And then we'll have transaction size day fixed effects, which are going to control for any variation in trade size discounts or premia throughout. So this is kind of our baseline regression for the kind of first set of results on sophisticated investors getting high discount. Of course, as we were talking about, private information is generally not observable, and so identification, of course, can be challenging. Our kind of primary identifying assumptions are going to be one, and this one is like a mouthful, but we kind of already talked about it. So essentially, we're assuming that prior investors' performance is indicative of dealers' perception of investors' informational advantage, which is just a fancy way of saying that, when dealers want to potentially learn from an investor, they're going to look around and see who's been performing well recently. The second assumption is kind of a standard difference in difference type assumption, that informed and uninformed investors would have continued to receive similar transaction costs in absence of the crisis and conditional all of our controls and this kind of stuff. So, we're going to provide a bunch of support for these assumptions. We'll see how much we get through in this presentation, but we'll make sure to do the most important ones. We'll do the kind of standard pre-trend analysis. We will measure the profitability of the trades that are receiving these discounts. We'll do a bunch of robustness to show that our informed categorization is not being driven by some of the other potential alternative mechanisms, such as client-supplied liquidity. And we'll also do a placebo test using some of the least informationally sensitive bonds. So just to kind of jump right into the pre-trend analysis, here we do a time varying estimate of the baseline regression. So this is the same regression, and we just allow for the coefficients to vary over time. And what we see here is that informed investors receiving trade costs on the order of 20 basis points lower than relative to an uninformed investor, from the same dealer in the same bond once the crisis begins. We think that this supports the parallel trend assumption, and we can see that this shock reverses just 1 week later after the Bank of England intervenes. Here we run the same regressions again, just in a pooled sample. In the first one, we drop a bunch of the controls and fixed effects to show it's not driven by any of those. 2 is kind of the baseline measure and corresponds to what I just showed you in the time varying analysis. 3, we use a more conservative clustering that is just at the investor and day level. And then 4, we use another measure for the value of information, which I'm won't go in here unless people are particularly interested. Instead, I want to jump into one of our robustness here because it speaks specifically to the question that I believe it was Jane had. So, one concern is that these investors are not being compensated for potentially revealing information to the dealers, but instead are being compensated for relieving the dealers of fire sales pressure and providing liquidity to the dealers. And there's some research that shows that dealers do compensate investors for helping them kind of manage inventory in a sense. So here we do several tests to see if this is driving our results. In column 1, we run the regression again, but we exclude all of the bonds that are being fire sold by the pension fund and liability-driven investment sector. Essentially, these are, the bonds in the top tercile of net sales from that sector. And so you would think that, if these are the bonds that are getting offloaded onto dealers, and those are the ones that dealers then need help managing their inventory to, if the results were really just driven by inventory management, then dropping these bonds should reduce the coefficient or drop it altogether. But instead, we see that it's statistically unchanged. In column 2, we drop all investor purchases. So now we're just looking at the sales side. So this is kind of even a broader idea of, if the dealers just want to, offload a bunch of bonds in this environment and they're compensating investors for this, we've kind of excluded those all together. In column 3, because we have this really nice, investor dealer linked data, we can actually look at the quantity of net flows between any investor and dealer. And so what we do here is we control for that. And so you might think that, if it was really driven just by this, then investors who are buying the most off of dealers, this would, kind of absorb our coefficient. And so what we see here is that actually, dealers or investors who buy a lot off of dealers are being compensated for this. They do receive a discount. So this, to Jane's point, suggests that some investors really are being compensated for helping with inventory management and supplying liquidity to dealers. But our coefficient, again, is statistically unchanged. In column 4, we use another measure, which is essentially, we look at the inventory of dealers right before the crisis, and you might think that dealers with a higher inventory before the crisis begins would be the ones with the highest motivation to offload their inventory once there's a bunch of kind of fire sales coming from the pension fund and liability-driven investment vehicle sector. And so, if this was really driving the effect, then we might expect this triple interaction with the size of the inventory to absorb the coefficient. But again, it's relatively unchanged. So I think all of this suggests that there may be some client-supplied liquidity compensation going on, but that it's really not what's driving the results that we're capturing in our regressions.
Yeah, if I can
Please.
just follow up a little bit. So does this also show in some way that the trades are not endogenously chosen? If the cost too high, they just decide not to trade.
I'm sorry,
may
can you
not
say that
be-
again?
So if the cost is too high, they may decide, the dealers may have more flexibility in just not to trade. They may not be that much panicked about this safe assets, right? They may even be required to, keep them on their books for various purposes, depending on who the client is.
Yeah.
What's
so
the
I think
alternative to these assets? Like don't you have to hold the treasury? No matter what's going on in that market.
they need to, at least for the kind of gilt-edged market makers, they need to, be willing to make markets on both sides throughout the crisis. Yeah.
Right. So they do have choice to participate only when the costs are low. Is it not the case? That's my question ultimately.
I'm sorry, I'm having a little difficulty. Could you explain it one more time?
Like, do they have a choice not to trade?
The
If the
dealers.
costs are too high, right? Now, not only dealers, but these the hedge funds or the informed.
The hedge
Right.
funds have a choice to trade or not trade whenever they want.
Right.
It's only the dealers that have some obligation to participate in the market.
Right. So it may be that they just don't get panicked, right? Whereas the other panic people, they just want to fire sale.
That they don't get panicked. Why would this result in them getting discounts?
Yeah, so they select participate. They're endogenously selecting to participate only when the costs are low and the discount is so attractive, so they participate. Otherwise, they don't get panicked and do not participate because the cost of trading is too high.
Right. Yeah, I see what you're saying now. Okay. Right. Well, so one thing that I think speaks to this is that the kind of, let me see, I'm not actually sure if I have this chart here. One thing that I think speaks to this is that the kind of liquidity costs that we're talking about here and kind of on the order of, 10 to 20 basis points. But we know that the returns that these kind of high performing investors made during the crisis was more on the order of 20 percentage points. And so, the kind of their returns to trading, the categorization of being informed is, not being driven by their, getting a discount here.
Yep, makes sense. Thank you.
Cool. Yeah. And, we can talk about this a little bit more later too, if you want. So these are kind of the first results. I want to make sure that we kind of get to some of the other results. This is just looking at it in non-linear terms. Actually, maybe I'll go ahead and do this real quick. So essentially, what we do here for the trade costs, instead of having them defined in absolute terms, like basis points, we categorize trade costs based on their tercile and the distribution every day. And so the idea here is that, trade costs will be kind of more dispersed during more volatile days. And so this kind of controls for that increase in dispersion as the crisis goes along. I think it's nice because essentially you see here that the informed investors are, they're less likely to get high trade costs, and they move down the mass distribution towards these lower trade costs once the crisis begins. Then, we're also going to use the same measure in this next piece of evidence, which speaks, I think, a little bit to what we were just talking about, which is how profitable these trades are. So, one way to think about whether these trades have some informational content and whether dealers are identifying trades with informational content is to look at the trades that received a very large discount and ask how those trades perform relative to others. And so what we see here is essentially on the left-hand side, we have the performance of the trade from an informed investor on the left-hand side, and on the right-hand side, we have a time varying dummy interacted with whether they are in this lowest tercile of trade discounts. So what this says is that once the crisis begins, the trades receiving discounts, and the lowest cost liquidity outperform other trades by 6 percentage points over the next 3 days. We also look at this as 1 day and 5 day and so on and so forth. And so I think this is again is a strong suggestion that these trades have some informational content and that dealers are, kind of identifying which trades may have an edge. So, all right, we're going to kind of more quickly go through these next set of results. We're going to look at dealers' behavior after gathering information. And so we want to run regressions of the following form, an outcome on the left-hand side, such as trade costs or trading profits. And on the right-hand side, we want to look at dealers who have more versus less informed order flow. And so, we could just look at their kind of the total amount of order flow coming from informed investors or the proportion coming from informed investors. But of course, this is, potentially endogenous. And so what we're going to do is we're going to create a shift share instrument based on their pre-crisis trading patterns. And essentially what we're going to do is we're going to say, for any investor, the amount that they trade with a particular dealer can be decomposed into the amount that they trade overall, and then the share that they trade with this particular dealer. And so, the way to think about this is, say an investor has 2 dealers that they normally work with, JP Morgan and Goldman Sachs, and normally they trade 50%, with each of them. Then, when the crisis begins, maybe they shift to trading more with JP Morgan than Goldman Sachs. And so then this, the share would change. Essentially, what we're going to do is we're going to fix the share to the pre-crisis share or the pre-crisis average for each dealer. And so what this means is we're going to avoid any confounding variation from changing in dealer investor matching over time. So, this is going to exclude any of the kind of switching variation that we might be concerned with. So using this, we're going to then look at dealers with more versus less informed order flow. And, we can't use our kind of dealer time fixed effects anymore, but now we can use investor day fixed effects. So this means that the model that you should have in your mind is essentially one investor on a day trading with 2 different dealers, one dealer that has more informed order flow and one dealer that has less informed order flow. And this essentially holds demand for liquidity constant in a kind of Quasi-Mian type estimator. What we see here is that a dealer with a 1 standard deviation higher informed order flow increases trade costs on uninformed investors by about 10 basis points in the week after the crisis begins. Next, we're going to run the same model, but instead of looking at dealers' trade costs on other investors, we're going to look at their trading profitability. And essentially what we see here is that there's very low trading profitability in the dealer-to-client market and very high profitability for more informed dealers in the inter-dealer market. And we think that this is dealers essentially monetizing their informational advantage in the kind of anonymous inter-dealer market rather than incurring potential reputational risk in the dealer-client market, taking a lot of money off of potentially important clients. Here, we're going to use our categorization of informed dealers and look at compare the top tercile of informed dealers versus the bottom tercile. And on the left-hand side, we're going to look at their net order flow over time. And we see that more informed dealers net intermediate or net buy less bonds. They're essentially kind of leaning against the wind less or absorbing less of the fire sales pressure. On the right-hand side, we see dealers' gross order flow. This is essentially their total intermediation. And again, the high informed order flow dealers are intermediating less. Really quickly, we kind of do this in, a regression also. We see that more informed are, net purchasing less, both throughout all bonds and in fire sale bonds. And for gross order flow, we see less of that in all bonds, but we do see it still in the fire sale bonds. This is the kind of the last main thing I want to show, since I'd like to get on to questions. I'm sure people have some, and I'd love to hear them. But here, essentially, we're going to look at investors' order flow and whether it predicts the pension fund and liability-driven investment vehicle order flow over the next 5 days. So these are rolling regressions looking at, the trailing week for informed and uninformed investors and informed and uninformed dealers at the investor dealer level for each bond, and whether that predicts the pension fund's order flow in the same bonds over the next 5 days. And what we see is that the investors that we categorize as informed significantly predict the PFLDI order flow, and the same thing with the informed dealers, but not the uninformed investors and not the uninformed dealers. We do a bit of work to reproduce some of our main results during COVID, but I think in the interest of time, we can pass on that for now. This is really just a summary of what I already said, so maybe it's a good time for me to stop and make sure that we get in questions here at the end.
Thank you very much.
Yeah, of
Any
course.
questions? I have a quick question, but
Sure, please.
I probably just missed it about the informed dealers.
Mhm.
How did you define that? Like, I understood the informed investors and all.
Yeah.
And is it
Sorry.
also common that they would restrict this throughout, like outside of the crisis, you think? Or
Yeah, those are good questions. Sorry, maybe I went a little bit quick here at the end. So for the dealers, we're going to essentially measure their share of informed order flow. And this is going to be, our estimate of how informed they are, how much information gathering they've done. And so, you could think about this in a very simple way as the quantity that they trade, with informed investors as a share of the total quantity they trade. And, in the regressions, we're going to do this kind of shift share instrument, but essentially it's going to be a measure between 0 and 100%. It's going to be, some dealers are trading a lot with informed investors and some very little.
so it seems like, I guess I'm asking which direction does it go, because it seems like you define them as being informed by them not trading very much with uninformed, and in crisis they seem to trade even less with uninformed. Is that the? And I'm just wondering if these are the, like, because they will already trade less with uninformed based on your definition. Is that correct?
Well, okay, so two
Like,
things here. I mean, I guess I think I understand your question. So here, this is going to be kind of a share. So this doesn't really say whether, we expect them to net buy or sell more. This is kind of more, proportional to their overall trading. And so, for example, here we see that, informed and uninformed dealers are both increasing the total amount of trading that they're doing over the crisis. It's just that the informed investors or the informed dealers are doing this less. Does that help?
I think I would like to know kind of outside of the. I think I would like to just generally know more about outside of the crisis, so that I
Sure.
have a basis for comparison. That would be that would help me, but
Yeah.
I'm not because
No,
I think I don't
no.
know enough about how they behave during the baseline, and that I think would be helpful. But
Yeah,
it
okay.
addresses my question. Thank you.
No. That's a good point. I mean, what I can tell you is that in general, the kind of informed proportion tends to be about 13%. And so you think about this as kind of like the baseline proportion of informed trading, or share of dealers informed order flow, and then it increases during the crisis. But maybe we can kind of do more to kind of talk about their behavior in kind of quote unquote normal times. Yeah, Albert?
Yeah, if there's no other questions, there's
Sure.
a couple of things that come to mind here. So the first,
Mhm.
coming back to my earlier point, like, is it just backrunning on flow, or is it real prediction of events? The beautiful thing is that you have very granular event. I mean, it's this whole episode about
Mhm.
what happened in the UK had more events for sure. People were responding, the central bank was responding. There's all kinds of responses, and if you know when they are in time, then you might have a dozen events instead of one, and then you can
Mm.
see if those events are being predicted by the flow.
Mm.
So it's not completely, yeah, I understand your point. It's one case, but it's, in a way, there's many events within the case. So you might want
Mm.
to look there.
Yeah. I mean, yeah. I would love to be able to decompose this into kind of like macro and front running kind of incentives. I'll try to think a little bit more carefully if there's a way that we can kind of identify kind of like mini episodes within that might make that easier.
Yeah.
Um,
And the
yeah,
other thing is,
it's a good
you
suggestion.
didn't calculate, I might have missed it, but you could in principle calculate how much money these dealers make out of
Yeah, I mean, we can kind of at a high level back it out through some of this stuff, right? So, for example, here on the inner dealer um, portion, we know that, this is kind of a one standard deviation increase in order flow results in about a 50 basis point average outperformance in the inner dealer market. And so, we could calculate their exact P&L, if we wanted, at least in this particular market.
yeah.
And at a high level, you can kind of multiply this by, the share of informed order flow and the amount going through the inner dealer market to get a sense.
Yeah, I mean,
I guess
this would
also
be
then
the,
you would want to add up the kind of additional transaction costs that they're getting through higher liquidity costs too. And yeah, we could do
yeah, I
this.
mean, this would be nice. Now I see that Björn is just behind me in the queue. I want to front run his question, which is the following.
Sure.
Björn and I have been, I mean, when you were talking us through this, Björn and I did something similar,
Mm,
because we were interested in delineating revelation of information, and we had a network approach.
okay.
And we found that the most central dealers, so that there is the more you get into the dealer network, the more central you get into the dealer network, the spreads are typically raised, except for the most central dealer,
Mm,
which is an outlier, because this most central dealer charges an incredibly low bid-ask spread. And then we're speculating. I just looked up what we're saying about what this could be, and it's exactly what you're saying, because there's this paper by Golosov, Lorenzoni, and Savinsky in Econometrica in 2014, where they have a theoretical model that has this as an outcome, that you might want to lose a little on an early trade if that's an
mm,
informed trade, where you can use that information in later trade. So that's a really
yeah.
neat theoretical. We
Yeah.
have some of that in our paper. I'll send it to you. But this is kind of, so I believe that this might be going on, and it's nice that you have more evidence on this. Anyway,
Yeah, it's very
I'll
interesting. I mean, just kind of briefly on this. So yeah, I mean, I completely agree. I think that the point about centrality is very interesting. I mean, there is some prior research, for example, by DiMaggio, who was kind of at Imperial while I was there, that really looks at kind of the centrality of dealers and, whether they're kind of, producing information of their own through observing order flow, for example. and also a bit on their liquidity provision and centrality. It's not something that we've kind of studied a lot early in the project. We looked at kind of controlling for, dealer centrality. So I guess here, I mean, this is maybe getting like really in the weeds, but this is the microstructure exchange. So like, I mean, there's a question about whether they are acquiring information or producing their own, right? And it's like, I guess the centrality argument is saying we are at the center of this network, and by observing order flow, we're getting a view of, the flows that other people are not getting, right? Whereas, the kind of perspective that we've taken here is this kind of information acquisition story. And I think the challenge for the information for I'm not saying that dealers, don't produce information. I do think they do in exactly the way that we're talking about. However, I think the problem for that as an economic motivation for these results is that in that case, we would not expect the dealers to give discounts in equilibrium, right? We would expect them in some sense to charge premia because, they're selling information rather than buying it is one way of thinking about it. And so the results about discounted liquidity, I think in equilibrium, I would find that difficult to be like sustained. And so that, of course, may be going on. And it could be very interesting to look at, for example, which clients are kind of paying for information and which clients are being paid for information and this kind of thing. I think it provides a whole kind of another perspective on the flow of information between these different investors. Cool. Yeah.
Yeah. So take a look at the Coauthored et al. Paper. That's really
I will.
quite
Thank you.
interesting.
Yeah, yeah. Oh, sorry. The last thing I was going to say on that just real quick is there's also a paper by Penter and I believe Dong Lu at LSE, which provide kind of some theoretical basis for this kind of thing. Yeah, very similar though. Great, thank you, Bjorn.
Yes, luckily Albert did not preempt my question.
Orthogonal information.
Yeah, very interesting paper. And of course, liquidity crisis in such an important market is of first order interest to policymakers. So do you have any lessons for policymakers here? Are we happy with the way this market is organized?
Yeah,
I didn't quite get, is the interdealer market also an OTC market?
Right, yeah. No, yeah.
Limit order book?
Yeah, so the bond market in the UK is very similar to the bond market kind of in many other places where essentially you have this kind of bilateral, non-anonymous dealer to client market, and then the interdealer market is, operated through just a couple interdealers, interdealer brokers who essentially act almost like an exchange, and it's more of an anonymous market. And so it has a very different market structure. And so
is that a request for quotes market, or is it a limit order book?
It is a limit order book. I should double check. I'm like 90% sure it's a limit order book, but now that you asked me, I should double check. I'm pretty sure it is. Yeah. So I'll double check, but I think whatever. I'm not going to speculate. I think but yeah. Anyways, it is a very centralized anonymous market through essentially kind of 2-3 interdealer brokers. I'm not sure precisely about the trading protocol. In terms of the kind of takeaway, I mean, ultimately the kind of conservative academic thing that we need to say is that we really need a model in order to kind of trade off the like informational advantages versus the kind of illiquidity. I mean, I think this really speaks to kind of what Albert was saying too, where, I think we provide evidence that there is at least some aspect of this that feels like it is front running, that it is reducing liquidity in the market, and the kind of very loosey-goosey intuitive idea I have for this, or way I have of kind of thinking about this in my mind, is that, in some sense, the dealers that are really acquiring a lot of information are acting more like investors and less like intermediaries. And then that is kind of reducing liquidity in the market at a time that it really needs it. Of course, this information might be really valuable, and so we kind of need a model to really decompose that. But I do think it suggests that, for example, in the heart of a crisis, um, policymakers, should consider kind of informational levers, in addition to other levers such as, regulatory constraints. I think things like quantitative easing, things like, or like asset purchases, things like forward guidance, these kinds of things that provide kind of information to dealers, or information to investors and dealers, and affect their beliefs, should have kind of a strong effect in terms of kind of ex ante design of the markets, whether we want to have markets that allow for the kind of structure of information flow that permits this kind of information chasing. Because that's such a big question and needs to be traded off with other things, I would be really reluctant to say kind of based on these results alone.
Sure. Thanks.
Yep, no problem. Any other questions here? I don't want to keep us late, but I'm happy to stick around if people do. Yeah.
While everybody is thinking about questions, I just wanted to say thanks to everyone for coming and remind you we have another seminar for this season in 2 weeks. We'll have Paige Strawberry from Utah, and I believe she'll be speaking to us about market fragmentation and price efficiency. So we hope to see you all there.
Great. Thank you. Thanks so much for having me.
Thanks
actually,
very much for coming.
Oh, yeah,
Go
sorry, go on. I was just going to follow up with one of Jane's questions real quick, if he's still there. All right. Well, I'll follow up with him more later.
Yeah, I'm here. I'm just trying to unmute. Sorry. Yeah, go ahead.
Okay. Yeah, no, I was just thinking there's one, now that I've kind of had a little moment to think about your question, I think one thing that we might be able to do that kind of speaks to what you're asking about, which is kind of like the order of arrival of informed investors, is we, in one of our robustness here, we look at, we control for the time since the last trade and the time since the window started. And so in some sense, this is asking whether the informed investors are, arriving more quickly when there's a favorable trade quote, for example. And so I think this speaks a little bit to your kind of timing of
Right.
when the informed investors are participating. Are they kind of just moving quickly to pick up, cheap quoted trades?
Right. Did you find that or?
Yeah. So
They
here
do, right?
in columns 4 and 5, we see, for example, if they trade more quickly, they do get a bit of a discount, but it's very, very small, and our coefficient is unchanged. So it seems to kind of not be driving our results.
Right. Yeah, no, this is very good, interesting finding. And even if they are selective about trading with the low cost, at least, I mean, it's pretty clear that the channel may or may not be information, but the liquidity costs are much different during crisis for those who panic versus those who are not. Right. So good paper. Really like it.
Yeah. Thanks a lot for your questions.
Yeah. Right.
All right. Well, thanks again, and we'll see you all in 2 weeks.
Cheers.
Have a
Thanks.
nice May rest of the week. Bye.
Bye.